And if you have any questions as well during the during the presentation, you can also always drop them in the chat. I think that would make the whole thing a little bit more interactive and also useful for us. Okay. All right.
Right. I will talk to you about carry. So I don't know how familiar they make you with by nature, I'm a derivatives trader. Derivatives are this very scary thing until you work inside them. And what I have learned from kind of doing this kind of professionally at a pretty decent level is that one of the most important investment variables that exists is what's called carry. Okay, what is carry? Carry is essentially what it's kind of the carrying cost of holding that investment. And I've kind of illustrated with some pretty terrible graphics here. You've got Sisyphus on the left. Sisyphus was a kind of Greek mythology kind of leader who Zeus kind of banished to having to push a rock up a hill for his whole life. This is basically the kind of analogy of fighting carry. And on the side, we've got some pretty cool penguins sliding down a hill. And the penguins are basically using kind of, let's say, the slope and carry to their advantage. And we'll talk about kind of like what this is, what it means, and how it applies to you. I'm struggling to change the slide.
Yeah, let me just help you.
Okay. Okay. So let's just go back here. Okay. We've talked about roughly what carry is. Okay, it's like the carrying cost that affects you. You can kind of be like a kind of a rent receiver or rent payer. I would probably argue it's probably up there as, if not the most important or very important part of portfolio management and trading. It really allows you to skew the odds in your favor. And we'll come to that a little bit later about how that works. When I referred to positive carry is when you directionally are receiving interest for facing a certain direction. And negative carry is something that you are paying away. Okay. It's particularly important in derivatives. It does exist in cash markets. But derivatives is where it really gets interesting because there's lots of funding costs involved. Just to check, I don't know how, it's quite hard because I can't see any of you, but just a derivative is basically like a contract that bases its value on something else. Okay, it derives its value from something else. There are four main types. There's forwards, futures, swaps, and options. There are a few more that are kind of a bit more exotic than that, but they're the ones you need to know. And effectively what they allow you to do is get a leveraged version of your current trade on. I think the one that people seem most kind of au fait with is kind of futures, and kind of implicitly probably more like commodity futures or equity index futures. Simple structure would be, if an index is 100, you can buy a future which will replicate the index, but you only have to pay, let's say, 10 in margin, which allows you, if you wanted to increase your amount of risk without having to fund the total amount of capital. Okay. Armin, could you change the slide
button? Yeah. Let me just do that.
Yeah, please. It's just not coming up for me.
Can you just stand still 1 second? Yeah. Okay.
Ah, there we go. Okay. Okay, so what does this look like in kind of real life? So I've taken a couple of examples here. On the left is the price for aluminium at the London Metals Exchange, and on the right is the price for WTI oil. I think this one's at NYMEX, which is out in the States. Okay, and basically the x-axis represents the kind of dates, and the y-axis represents the price. And what you can see is that, for aluminium, as you go into the future, it's more expensive, and today is cheaper. Okay, We call this curve a contango. And generally, if you're owning this asset, you're having to pay negative carry because you're having to pay tomorrow's cost all the time. And if you're short this asset, you're going to be receiving carry. Backwardations are opposite. They will reward the long holder and you'll pay carry as a short holder. And I'll go a little bit into why these exist in a sec, if I can change the slide. Okay. So carry is, like kind of a function of non-linearity between the spot and where the forwards are. Okay. And in many instances, carry is something that the asset issuer will have to pay you to hold on to the asset. Some of you may be a bit more familiar with things like stocks. And what you tend to find is certain stocks pay very high dividends to get a stable asset base. When you think about currencies, the way they sometimes teach you economics is, it's about kind of withdrawing and adding liquidity. That is true. When you go to more like emerging market situations, a lot of the time the interest or the carry they pay you is basically where the market clearing rate is for that currency to be supported. Certain currencies there's not a massive demand for kind of naturally. And it will really and like how this carry is kind of calculated depends on the markets in question. So we will run through these in a bit more detail. So commodities, basically you have a financing rate plus your cost of storage. Foreign exchange, you have current and implied bootstrap rates. I'll explain what that is in a minute. Interest rates is generally term premium and implied policy. Credit is the interest rate factors plus defaults. And equity is generally financing rates less dividends. Just a caveat here, there are some more factors for some of these markets. I think this is a pretty good place to start. If people really want to kind of howl me afterwards, we can go into some of kind of the minutiae. And let's have a look at them kind of individually. So commodities, okay, like why does aluminium have kind of the shape it did? Okay. The simplest way to think is that in a completely normal, functioning, very healthy market, if you are dealing in a physical asset, the price tomorrow should be higher because there's basically a cost of holding that asset. So in the case of our aluminium, 1 ton of aluminium is going to cost something to store in a warehouse every day, and especially store securely. And we also make the assumption in markets that we actually finance this. Okay, so we say, how much is it going to cost me as a commodity trade house or a bank to borrow the money? And then how much does it cost me to store? Now, this is where kind of financiers and arbitrageurs become quite a big part of a market. This is one of the biggest areas in the whole of kind of global economics. You'll have heard of potentially some of the trade houses. This might be Glencore, Trafigura, Vitol. These guys really ensure that the market doesn't kind of unravel and stays quite kind of orderly. So I've kind of given you an example here just so you can see how it works. Okay, so in this example, aluminium's $1,000, dollar OIS. So that's like our overnight index spread. It's our financing basically. And the financier's credit spread is basically what the bank is going to charge them over where the government can borrow money. So in this case, me as a financier can borrow money at 4.5%. So we take our kind of cost of storage as 25 cents a day, and we add into our financing that $1,000, and it gives us kind of an annualized financing cost. So all things being equal, right, what you would expect is that today aluminium is 1,000, and in 1 year's time, its cost is 1,136.25. And of course, this doesn't exactly happen like this in reality. What we tend to get is kind of like kind of surges in supply and demand, which in cases will push this beyond finance. And if we say that the finance was greater than that, what will happen is, so as an example, let's say aluminium is 1,000 today and it's 1,500 in a year's time. Me, let's say, as a financier, will go in, I will buy the aluminium and I'll sell aluminium forward, okay, in 12 months' time. And I will net the difference between my costs, which is 136.25, and my like $500 that I've sold it over the, so what's that, like 400 and call it like 460-ish, like I'm gonna take in. And this is really big market. And you might have seen there's instances where over COVID it was quite pronounced that oil traded at a negative price. And oil basically traded at a negative price because the market ran out of storage. Okay, people would have taken oil in with the shape of the curve at incredible like gains. And effectively, when it got to negative 47, that was basically the market's clearing price for how much it would cost someone to move something out of storage quickly and settle that oil. Okay. A backwardation in commodity markets while we're here tends to happen when you either have a supply shock. So you might have a scenario where you have something that's maybe like quite cyclical in nature, like a crop. So you might have a crop failure where demand stays relatively constant and the crop fails. The other side is you might have a scenario where demand massively outweighs like the available supply at the time. We have that situation kind of going on at the moment in energy. I think a lot of people have seen that, like, there's kind of a pretty material energy scenario going on in the fossil fuel world. And we're seeing that basically like demand is relatively outweighing supply, which means that people are prepared to pay more for that oil today than they would do in the future. We've got, I mean, could you make it so I can change the slide again? I can't seem to be able to do it. Okay. Foreign exchange. Okay, why does foreign exchange curvature exist? This one's a little bit more simple. Essentially, we have two assets and we're looking at the varying carrying cost between them. Okay. And I'll just give you a couple of kind of real world examples here so you can see how this works. If we look at kind of euro dollar, okay, this is the rate that how many euros does it require to basically how many dollars do you get for €1? Now, if we had euro rates of 0% and we have dollar rates of 5%, the 1 year forward has to be 5% higher, right, than where we are today. Now, you'll have seen that in the intro, I referred to something called bootstrap rates. Bootstrap rates effectively is that it's not always as linear as you think. There's an implied policy of where people think their things are going to be in the future. You would otherwise end up with some quite funky kind of scenarios where someone would change rates and then the whole forward curve would have to move by that amount. What tends to happen is that the market starts to price in how much of a policy shift happens before the policy shift has actually happened itself. What you'll see on the kind of chart at the top right is this is what euro dollar the forward looks like for the next 30 years. Okay. And because dollar rates are higher than euro rates, okay, the forward has to be upward sloping. How do we kind of know that? We know that if dollars are higher than euros, okay, and all else stands equal, I want to be selling euros, buying dollars in the future, and I'm going to receive that carrying cost, okay, over time. So if we think that how we do that is we say, okay, well, the slope basically pays me, okay? The main kind of forward that you will probably experience in your lives if you go into finance is something called Tom Next. When you trade currencies, generally you trade something called spot. Spot is basically the value of a currency in 2 days' time. You can trade for today if you want to, but most of the time you're speculating or hedging and you don't actually want to take delivery of the physical cash. So if I buy, so it's Monday today, if I go out and let's say buy euro dollars today, I buy $1 million euros of euro dollar. tomorrow I'm one day closer to having to settle it. So tomorrow, and on Wednesday, if I did nothing, I would receive that euros at the price that I paid. Okay. Now, if you're doing something in the physical real world, you're doing real world transactions that need to settle. You would obviously go push to settlement, but 99% of the flows in the market have nothing to do with what actually settles. So I would have to go into the market and I'd say, okay, well, I've bought euros for Wednesday. I have to go in and effectively sell euros so tomorrow I would go in and sell euros for Wednesday, and I would go and buy them for Thursday. Okay. And this would roll my position one day forward. Okay. And in doing so, what I would do is I would then have to pay a spread of that, which is basically the interest over the time period. So in this case, it's one day. And what you see there basically on the bottom right hand corner is a live price from JP Morgan, okay, that I put in the thing. So if I want to sell my euros and then buy some, I'm going to pay 0.666 pips. Okay. Right, let's go on to fixed income. I can't seem to change it. Armin, can you do that again for me?
Of course.
Okay, interest rates. So interest rates is this kind of market that obviously a lot of you are economic students, but me as a law student, I came into the kind of finance world and I didn't quite realize kind of the scale. If anything, these are the biggest debt markets, are probably the biggest market with foreign exchange. How does interest rates work? So we have a number of interest rates within the market. So when you think about an interest rate, most people are thinking what the Bank of England's policy rate. Okay. I would probably tell you that this is a fairly lagging indicator. By this point, when you're actually trading professionally, the market moves well before and starts pricing things well before the interest rate moves. A lot of people are quite surprised when a central bank puts up interest rates and the currency falls. This is generally because something is already baked in. And I've tried to kind of show you this. So the top right-hand curve, okay, so this is all in pounds, okay. This is where people think the Bank of England interest rate is going to be at different tenors, okay. And you see today that we're at sort of circa 2.5%, okay. It's like a corridor which they think, and within 2 years the price is somewhere up towards 5.5%. And this is basically the market baking in and sort of like listening to the central bank, but also telling the central bank what it thinks is appropriate as the interest rate. And a lot of the time, the central bank will actually just follow what the market tells it to do. Okay, it's it's kind of the path of least resistance. Okay, so you can see from this, the market is kind of expecting that the central banks are able to put up interest rates quite aggressively for the next 2 years. And at that point, it actually thinks that the market will actually have to start cutting rates. Okay. There are some kind of flow dynamics which like skew these curves, but they're fairly kind of a fairly decent picture of what's actually going on in the world. The bottom right-hand corner looks at where the market is pricing these particular rates in the future. Okay. And it's quite a useful indicator of kind of how people think that policy will move forward. But it also tells us, like, can we achieve carry? Okay. So what we really want to be doing is we want to be rolling up the curves. We want to be rolling up curves, okay, and selling them on the way down. So if I was to say put a bet, if we look at this Sterling Sonia curve, I don't know if you can see my mouse. We have like let's say we want to bet on the 1 year rate in 4 years' time. Okay. If I wanted to bet on that rate falling, I would have to pay all this carry, right? That's going to go against me. Okay. For at least the next 3.5 years versus today's prices. Okay. That's going to be like a negative factor on my profit and loss. I genuinely don't want to do that. Okay. I want to be thinking, is there a way for me to generate the same trade and I have kind of a tailwind rather than a headwind? And I'll show you what this kind of looks like in today's markets. Can I change the slide? Sorry, I'm unable to change the slide again. Okay, next one. Okay, so why do we do it? Why do we care? Okay, most people won't believe this as students, but most very, very good professionals aren't much better than a 50-50 coin flip. Many billionaires have been made on a 50% win rate. The main goal is to kind of cut losers quickly and run winners. And if you can achieve some kind of decent ratio between these two, and you can size your trades protected like properly, you'll have a very, very decent career in trading. Okay, what most people struggle with most in trading is risk management, and a lot of that is genuinely ego. Most of us don't like the idea that we've put a lot of work into something and that we're wrong. Those that are able to cut that out generally make the best traders, the most successful people. That is, discipline is kind of like the rule of the game. So how does it work? So when we think about carry, what we're really doing is, if we were constantly flipping the coin and someone said, I'll pay you to flip the coin, right, but you keep the 50-50 odds, is kind of the equivalent of having positive carry in your portfolio. It allows you to basically create a buffer in your P&L, which you can use to trade more aggressively against. Okay, and the most common example of this is kind of interest rates, and I'll go through an example of that in a sec. And what you've seen, I don't know if you guys recognize any of the guys in the pictures. The bottom left is a young George Soros. The guy in the middle is the guy called Louis Bacon. He runs a very successful hedge fund called More Capital. And the guy on the right is Paul Tudor Jones. These are probably arguably three of the greatest traders in history. And what you'll see is that their returns were far, far higher in the kind of 80s, 90s period, maybe the double O's. There are some kind of structural reasons, but one of the main reasons is they had so much carry that they could bet very aggressively without much recourse. And what does that look like? Right, hopefully it will let me click through. Okay, so this is kind of an example of how someone might think about it. When you were in, let's say, the 1990s, you could buy 2-year bonds at 8% coupons. 2016, I've just taken as a kind of a snapshot, you could do it at 1. So just by holding 50% of your portfolio in kind of effectively a risk-free rate, I would be sitting on 4% carry by the end of the year. What did Soros do, and Druckenmiller and some of these guys that you've heard of? They had ways of kind of levering this trade, and they would be sitting on kind of somewhere between 4 to 10% a year. Now, you can use many derivatives to lever that again, where you purchase options or you trade futures, which allowed you to take incredible amounts of risk with actually not that much concern that you were going to have a negative P&L. You compare that to the kind of environment that we've been in the last 10 years, especially in Europe, where you've paid negative carry on your cash, and it's very much forced you into riskier things at the same point where the market hasn't really wanted like a riskier trading style. And what you see is that it creates incredible opportunities if you can have kind of carry as your tailwind. Okay, and we'll show you a couple of examples. Okay. Okay. Here we go. Okay, so these are a couple of examples with you for you to kind of think about today. Occasionally in a market, you get a scenario where there's a very strong fundamental driver. Okay, right now we have a very, very tight oil market. We have a very aggressive Federal Reserve. And you can kind of get paid to put these trades on right now. Okay, so if I buy oil 1 year from today, it's currently 14% cheaper. These are as of Friday, I think, 14% cheaper than today's price. Okay, that gives you a buffer. If oil's at $100, you're basically buying it at kind of 85, let's say 86. Okay, the same is true of the dollar, right? So we have this position where you have this like very, very hawkish Fed, and you're getting paid to sit in that trade. If you trade dollar yen, which is a pretty decent barometer trade for kind of like real interest rates, you're currently getting paid 5% a year to put it on. What we do as a fund is we might buy that in the 10-year space, and we might buy it at somewhere around a 50% discount. To give you an idea about how we might think about it, the same is true for oil. You know, like, why don't I buy oil 5 years out and I can buy oil somewhere around $60? It's a much more attractive proposition when you think about it. Today, you're having potentially a recession. You need oil to fall so far for you to actually meaningfully lose money. Okay. And you can see the difference of what this kind of does to your return. So if you look at the charts in the bottom, okay, this is the rate, this is the difference between the Brazilian real and the Japanese yen. Okay. Now, if you look at a kind of spot chart, which is the left, okay, you'll see that Brazilian reals have been in a pretty consistent downtrend versus the yen for pretty much 30 years. Okay. If you factor in the carry that Brazil pays you, okay, against the yen, you actually get the chart on the right. So it can show you just how profound this can be as like an impact on your actual P&L. Okay. And it's something that you should always be thinking about when you're thinking, especially with kind of higher carry items. And as interest rates are trending somewhat higher at the moment, this is going to become a much, much bigger factor in your portfolio. Okay. If you could do the honors and just do one last one, I'm pretty much at my last slide. Okay, so to give you some kind of idea of like, you know, this is a bit anecdotal for me, but you don't really want to pee into the wind. Okay, and our little guy on the right is doing that, and it's not ending too well. And this is kind of showing the effect, right? So if you look at the top chart, this is basically a euro dollar future versus euro dollar cash. And you can see that this line underneath is basically the extra carry you've earned through interest rates, right? And you can see that when the carry is kind of positively trending, let's say from 2001 to 2005, it's quite supportive of the euro. And you're seeing in kind of recent years that this is really, really getting like quite out of control. The gap is so big between the two policies that it's like an anchor dragging the euro down every day. If I want to buy euro dollar spot, every single year I'm paying away 3-4%, right, to hold that position. If I'm a leverage fund, right, like a hedge fund, I'm going to say maybe I have 100 million fund. I'm probably going to have this on in like 300 million, right? So the negative carry that you eat as a fund compounds. The same thing for the positive carry. So we're always thinking about like, you know, like what does it cost me to stand still? You know, where is my break even? And a lot of the time your break even's like a long, long way different to what you think. Okay. And then can you just do one last slide, Armin? Sorry,
Yes,
I don't know why. Okay, so things to take away from this. When you're thinking about portfolio construction, and I know that a lot of you are kind of quite focused on equities, you need to think about how you represent your thesis. Okay, there are many, many ways to represent the same idea. Okay, there's the kind of like the vanilla version that you may think. There may be a second derivative, and you want to try and work out if there's a way that you can make the market pay you to put that trade on. Okay. The second one is thinking about, can I make my portfolio generate carry standing still? As in, is the market paying me to hold my positions? Okay. In doing so, you're going to be able to provide yourself basically a profit and loss cushion, okay, which effectively keeps you in the game longer. The final thing just to think about with carry, okay, in the instance where people are paying you an enormous carry, okay, and we see this in certain emerging markets, you have to remember that liquidity suddenly becomes a factor. And I've seen it many, many times in my career so far, where the in trade may be doing something in the Egyptian pound, they're paying you an enormous amount of money. And what tends to happen is something goes bad and everyone tries to leave at the same time. So what you tend to find is that different types of carry react differently in volatile scenarios. So when you think about it, you need to go back and have a look at like what happens in a volatile scenario, okay? And is that a fair reflection? And are you too big for that market? Okay. I'm going to leave it there, and Armin's going to talk to you a little bit about catching trends and kind of remote and geopolitics.
Should we take like first some questions, George, on this, or should we like bundle all of them together at the end?
Let's bundle them all together at the end. We'll go through all of them.
Okay, perfect. So as you probably have learned, or when you study economics, a lot of what's happening in the economy is about trends and business cycles, and there's no doubt that it's better to be on trend. A rising tide lifts all boats than not be on trend. And I think the first, because George mentioned this, so trading is very much, or decision making in general in life, is very much a game of probabilities. And what everyone tells you, and I remember that when I was at university, especially economics professors, is not to predict the future. But what you have to understand in real life is that you make decisions and predictions on a daily basis, hundreds of times. So how so? So when you came here today, you pretty much made the prediction that the best way how you could spend your evening is sitting in this seminar and to maximize your value according to whatever your circumstances are. If you're enrolled in a degree, you make the prediction that this will increase your skills and your value or earning potential in the labor market. When you go to a restaurant, you make the prediction that you will derive value, let's say a good meal, good experience from this decision. So you're always trying to turn the odds in your favor. And often, it's not a time series like it is on a Bloomberg terminal, but often it is the historical data or evidence that you're using might be ratings, recommendations from friends, or your own historical data, your own experiences. And therefore, making decisions, and it doesn't matter if you become a trader, a consultant, if you become an investment banker or an entrepreneur, is really that you become aware of your decisions, of your predictions, that you are making either explicitly or implicitly. And it's important to understand that some decisions that you're going to make will have a large impact, right? So like, let's say you're getting married, that's, quite a big decision, quite massive impact. Same as like with the career choice. Some decisions are obviously kind of like not very important. So the impact this will have on you, let's say, what you're wearing right now, for example, it might be not very important. Some decisions you control, and some things you cannot control. You can always control, obviously, how you react, where the ego part that George was just mentioning comes in. So you can always control how you react about something that you cannot control. Okay? If this is all true, then it doesn't matter if we, trade a particular market, if we are launching a new product, if we are investing as a venture fund, we want to align us with the odds, okay? And even though we only, let's say, have a 50% win rate, as George mentioned, and we are cutting if we are losing, and we are increasing exposure when we are winning. We want to align ourselves to big macro trends. Okay. So we thought about it. I thought about it like what kind of trends I should come here today. And obviously everyone's talking about the Fed, some energy markets. And you have this already in the news. So what we thought is we come with two trends that are much, much bigger. But before we start, we want to actually understand a little bit better why trends are, making a difference between, grinding it out or being effortless. So when you, for example, look at, the last 20 years, so this is like from the Daily Mail in 2000, it was pretty much Amazon, and this was the website, was seen as a fad, right? Since we had QE, we have pretty much, the stock markets, or in general asset holders, are doing quite well. So it doesn't really matter what you invested after kind of QE was really implemented after the great financial crisis, you would have done well. You could actually if you want to check that, you can look at wine prices, Rolex watches, like a lot of alternative assets, and you will pretty much find that you have a correlation that's not one, but it's close. Okay. And obviously, if you look at the last trend over the last 20 years, one of the biggest for sure was the rise of China. So whatever you did with China, pretty much you were always winning. There was not many scenarios where you actually could lose. So what are two kind of interesting trends that you should be looking at, that we selected for you, that we think are quite big, and that not everyone is looking at, not everyone is talking about it. Number one is geoeconomics, or why you as an economics student or a trader suddenly have to understand how politics works. Okay. So in order to understand this, we cannot now, go through loads of theory and loads of kind of complicated literature, because we don't have that much time. Obviously, after we have the Q&A, or when you kind of want to ping me afterwards, I'm happy to go into more depth. But in essence, what you had after the Cold War was you had a so-called unipolar moment. Okay, you can look that up. The term was coined by Charles Krauthammer, and it pretty much referred very much to US dominance. So the best tech came from the US, pretty much best education, best pretty much best everything. Okay, and then as you see, there were a couple of nations really trying to export all sorts of stuff, like Japan and Germany. So we're doing rather well, but there's a massive gap, and you only see this by this very kind of rough GDP numbers. Obviously, there are loads of numbers how to measure that. So the way how you think about this in terms of politics, it works like a solar system. Okay. So the US in this case is like a sun. Okay. All other nations, all other kind of players, they are just circling around the sun, circling around the US. Okay. In this system, the interesting thing is, because you are so dominant, they are rational decisions, and rational decisions are determined by market-based outcomes. Absolute gains matter. Why is that? Because no one else can challenge the rules, right? Since the rules are fixed and determined by, in this case, the US, you cannot benefit from a change of rules. Okay? So obviously, as we just discussed, the thing that we are really talking about is power. Okay, so I depicted this in one chart with this GDP number. But obviously, what we are doing is, when we are looking at nations, is that we want to see their capabilities. So you might have heard about Ray Dalio's, Bridgewater Fund. He's now kind of popular. This is, for example, how Bridgewater measures power for the UK. Okay, so you see like the rank. You see, okay, what's the debt like? How is this doing at the at the Z score? You see output. You give like different scores in terms of innovation, technology. It's all not that precise, and there are kind of loads of things to consider. But like this pretty much gives a nation, these are the capabilities of a nation, okay? And every kind of nation finds itself in a structure. This can be, okay, you are part of the European Union. This can be, do you have veto power in the United Nations? What kind of relationships do you have to neighboring countries? Because geographies might matter, because you have some sort of dependence or on the other nation. And obviously, these three factors, also these two factors, and obviously this is like a reflexive relationship. You might know what reflexivity is from from markets. The same is true here. So you have incentives that are determined by the capabilities, but obviously, often these incentives and the structure also determine the capabilities. Okay, and at the end of the day, it's always, if you think about it, like when we talked about like just the rules right now, it's always kind of a little bit of a game theory thing. So you always cooperate or defect, depending on your position here, which is very much like an interplay of this kind of stuff. Okay? If you heard this all for the same time, might be a little bit confusing, which is why I linked in this Ray Dalio's video. Obviously, they made this kind of like splendidly with like loads of animations and stuff. And there's also a fantastic chart pack that you can download. So both are linked in the presentation. So if we look at this now, having this in mind, what does it mean now for where we are today? Well, where we are today, and that's very interesting, is we are not in a unipolar moment anymore. We are in a world with two solar systems, okay? So you might have heard about the splinternet. You might have heard about trade wars. You might have heard about a US-China tech war. Well, the reason is that you have two solar systems now. So nations are kind of circling China and they are circling the US. Okay? And now the whole feature of this system is changing. So if you're a macro trader, you now will probably expect very different outcomes from what you expected over the last 20 years. Over the last 20 years, since we just mentioned, the rules couldn't be changed. There was no gain in changing the rules. Okay. There was no geopolitics. There was no geoeconomics. There was nothing of this stuff. Politics was a joke and pretty much like just going into the political science departments of the universities and maybe some think tanks. Okay. But now being rational has changed, because rational decisions are now determined by strategic outcomes. In other words, not absolute gains matter anymore as much as they used to, but now relative gains matter more. Okay, so your win, like compared to someone else, whatever the win really is. And why is that? Well, if you now, let's say, you understand this, obviously, that these kind of, look very similar, and the capabilities of, these two nations are very similar, then rules can be changed. And this is exactly what, creates also volatility. Because it is very much if you can turn, the best way how to turn the odds in your favor is to turn the rules in your favor. Okay. So what does that mean now? Let's say, or where are we going with this? Well, let's say for the next kind of like 20 years, and now we looked at this two solar system, and pretty much like, what are the odds of this kind of continuing? Well, there were people that kind of analyzed this. This is like the kind of the little bit of a summary. Whenever it's called the Thucydides trap, because it comes from a Greek general that was pretty much figuring out during the Peloponnesian War that Athens and Sparta, so Athens at the time the dominant power, and Sparta, they were actually like, had to go over, go through conflict. Obviously, this ended in war at the time, but that conflict was inevitable. And the reason is because now that you are a rising power, you want to have your fair share, right? So it's not that like, the new power is evil or whatever, right? This is sometimes a little bit funnily portrayed in the media. You just want to have your fair share. And pretty much that is related to your capabilities, and the measurements we could kind of like see, and you can check them out in the video that I linked. But pretty much, if we look at what's kind of happening historically, looking at the historical data, well, I would say the odds are pretty much for continuous competition. Okay. And, like the funny thing is really that we are just seeing the tip of the iceberg. So I'm not sure how much you're following what's going on in China in terms of their economic policies, but you should definitely check out their dual circulation strategy, because that's pretty much from what we just talked about. Onshoring, okay, what you might have heard about as well, or the term deglobalization, what some people you might have read in the news, or when, trade wars was like a hot theme, or I think yesterday, some kind of new measures for the chip industry were imposed that were used in the Huawei case. So all this is pretty much just the symptoms of the system change that's gonna intensify dramatically over the next, decade for sure. And what's like, what's the principle to follow here? Like I'm trying to, obviously there could be many, many more points, but what are some of the like the takeaways here? What do we make out of all of this? Well, like your career and life will be defined by an increasing political competition. And you shouldn't see this, first of all, I think the first thing, especially if you're in finance and you want to kind of stay kind of, rational and not get too, hooked up by news and other things. And also like to, to look at analysts and, let's say judge the quality of the work, be like totally indifferent and don't look at it in a normative way. It's a feature of the system. It's not good, it's not bad. There's no good, there's no evil. It's a feature of the system. Okay? Then what you want, I think, through your careers, or highly would recommend it, you want to get exposure to both solar systems. So innovation, opportunity is not only found in the Western world and Japan anymore. It's much, much broader. And I think you really, really want to understand this, because even like, if you, for example, haven't been in China, then you might not even know that in many aspects, it's like, it's just like a totally different universe, and some things are way more ahead, some things maybe not, but like you have to kind of like, in order to make an assessment what's good or not, what's working, what's not working, you need context, which in other words, you need exposure. Okay. The more strategically important an industry is to a nation, the less it will be able to move from one solar system to another. That's one kind of like takeaway from this change in the system. That's very important, because if you are an asset allocator, you will need to look at this. So everyone right now looking at Taiwan and the chip industry, and how this with Intel might be playing out, if they might become like a little bit more the player, but the platform, or if TSMC is going to stay that way, and so on and so forth. So everyone is already talking about it, will become much more relevant over the next years. And then you want to be long-term bullish countries, industries that can take advantage of this change in flows. Okay. So here we can think of Vietnam, Mexico, India, to just name a few, because they obviously are also part of the solar systems, be it in one or another, and they are playing their roles. And for example, for these three here, they will be like very much in support of US investors and US politics, and therefore US capital. Okay. And you want to be bearish of some countries and industries that were like really dominant and kind of like, did really well in this old regime. So in the, in the unipolar regime. Okay.
Sorry, just to interrupt you very, very briefly before you continue. If anyone does need to dash off, we have overrun slightly, so feel free just to pop off. Yeah, thanks very much, Armin.
All right. So, and obviously, like, this is not, investment advice, but you obviously need to be other factors need to be, you need to take other factors into consideration. But like this kind of system change affects all broader odds. So whenever you look at anything, at any asset, if this is the starting point, it determines the absolute basic odds. A lot of like ceteris paribus, right? So everything else like equal. Okay. So a lot of things can be, like can obviously affect this as well, but this determines the basic odds, because these are the systematic odds. Okay. So the other trend that I want to talk a little bit, is this thing that came up for most people during the pandemic. And this is, what's known under kind of remote work, or what we would kind of like say is more the detaching value creation and economic output from physical location. And so obviously we don't have time to go into like everything in development economics, but I studied development economics a lot, and like pretty much the outcome was very much, okay, so we have this agrarian society, and during the Industrial Revolution, when we like built like loads of factories, economic output, goes up, and to actually get rich or get developed for any nation requires you to industrialize and urbanize. And the same thing, like the factory for the blue collar worker is obviously in the information age, the office worker. Okay. And if you think about it, like cities or like location in general, that you will understand that like what really kind of makes them so powerful and like makes them add so much value is that they have network effects. Okay. If you don't know exactly like how networks effects like work and why they're important and why every kind of Silicon Valley startup looks at them and why they're kind of everywhere, I linked this kind of NFX has this great kind of like course on network effects. So you can check it out at your own time. But like one of the strongest network effects really is in the world that we have our cities. And this is where most of the value is created. This is really at odds if you think about it, because and this is what this quote is here about, is talent. So be it IQ or different kind of measurements of talent is kind of equally distributed, right? More or less, right? Across the world. But opportunity, so pretty much where the value creation is happening, is really not really kind of well distributed. It's really kind of clustered, right? And that's obvious because this whole kind of game that we just like discussed here is really about creating and self-enforcing cluster effect all the time, right? And then there's this quote that I stole from someone on Twitter, but I think it's pretty much pretty accurate. It's for thousands of years, if you were a sharp, ambitious young person, and this is true of the Medici, it's true for the Greeks, you had to go to the city to basically get opportunity. And this is like more or less, still true, right? Like for like at least like 70% of all jobs and so on and so forth. Well, but then now, when that's very interesting, and I think that's pretty much why we are talking about this, there was this kind of like COVID thing happening. Not sure if you remember, but it obviously was a massive booster because people were forced to pretty much work remotely. Okay.
I'm terribly sorry, Armin.
Yes.
We unfortunately only have this room for another 5 minutes before we get kicked
all right.
out.
So I wrap
it up slightly.
Yes. Okay. I wrap it up then a little bit quicker. So so where we at? So you can check out some of the stats in the presentation. I linked a couple of them, but in essence, what it will mean for you, and in order to wrap it up a little bit quicker, let me just think what a slide is that we are going into a world where it might be more important than the internet, and the reason is that value creation is really detaching, right, from location. And you have like billions of dollar companies starting to be fully remote. And the reason is not only because people like it, which they do. So like all surveys suggest, like the one from McKinsey and others, that 87% of people really want it. But it's also, and that's what I kind of like put my quote in here, it really doesn't really matter if they like it or not, because companies will be forced to go remote because it's a change of before I had people, and then I had like, people in, let's say, an office, and then I put in software and processes to make everything work. Now, what we have with fully distributed companies, we have software and processes first, and then we insert people afterwards, which is like a very, very efficient way how to pretty much, how to be cost efficient and how to compete, which is why on-site companies will not be able to compete in the future with remote companies. Okay. And what obviously like a few kind of like recommendations, your kind of, because we are in this transition phase, your potential employers and management will be terrible for your junior experience in many companies, because people don't know what they are doing right now. But at the same time, you should really embrace this and study about how this works and how this trend is playing out. Okay, I also linked the GitLab, which is like a good documentation for a start here in the presentation as well. And now we would have definitely 1 minute to tell you a little bit about macro mentors. George, you want to give it a quick shot?
Yeah, sure. Basically, Armin and I came into finance from maybe like not always the most conventional routes. And what we basically found was that it's the final hurdle that matters, which is the ability to be able to phone someone up and ask a question. If we could learn everything out of books, we would write algorithms and then we'd all sit on boats and be rich. Unfortunately, we can't do that. And what we have generally found is that the internet is like an incredible resource, but it answers something close to your question, but not your actual question. And it's a very ineffective way to learn when you actually want to go into specifics. So what Armin and I are trying to do with Macro Mentors is basically make people who have the answers available to you. We effectively kind of canvass the world kind of slowly and convince people to join our kind of, let's say, mentoring pool. And that involves them basically making their time available for purchase. Okay. And that may mean an Ask Me Anything session. It may mean a regular mentoring relationship, or it may mean a kind of masterclass in a particular topic. And the idea is that, you know, you guys are going to be in quite a kind of period of flux in your lives where you're going to be entering this kind of employment landscape. And as Armin said, the decisions you make now are actually quite big ones. So if you think you're into private equity, or you think that you have an interview somewhere that's meaningful and it really matters, we are trying to make it available so that you can buy someone's time who's actually in the job, okay, or potentially in the company, and you can kind of, let's say, ask them all the questions that you really need to know, okay, about an industry, about how something works, a company. We've been sort of like running the company as a kind of like the project that we're running. We're currently making a few changes to how it works. I would highly encourage you all to sign up to, if you go on our website, there's kind of a distribution list. And we are starting to basically interview some of these mentors, and it will show you that basically there's a lot more jobs out there than you think. Okay, people do all weird and wonderful things. We're also trying to highlight some of these people, what the journey they've been on. 99% of the world don't do a grad scheme. I know that it's kind of drilled into you that it's a very big deal, and it's obviously a great way to start, but not everyone can have one. And it might give you a little bit of context. And then you're actually able to go out and purchase these people's time if you want to. I do appreciate your students, and that like money's not always the easiest thing to find. What we have generally seen in our careers is that those that kind of invest in themselves tend to do the best. And I guess that's our kind of Macro Mentors pitch. I think.
Hi there, I'm just in the library, so I cannot be very loud. But like I was just looking on the source point, like there's a source clips that you were showing there, like between China and America, right? And you were showing that that if you invest in China, like it's going to be like you're gonna have a win-win situation, right? So does it mean that the strategies that you're like implying to is like based on very long term? Like it's not like, hey, get rich scheme in a year or two, but it's more like a 10 years progress.
Is this a question for me? Yes.
Yeah. You were talking about that one, Armin, right?
Yes. Well, I think it wasn't really about investing in China. It's more about being aware that we have now a player that's so big that pretty much is affecting the rules of the game. And the change in the rules of the game will affect you and your investment decisions as well as career decisions.
Yeah,
If that makes sense.
I would probably just echo that there's a lot of people out there who are kind of you look at them and they're very successful and very wealthy, or kind of somewhat perceived kind of geniuses. Most of them have caught like a big trend. Okay, they've basically got themselves in a position where they can leverage a trend. Okay, what does that mean? Like, if you look at let's say a real estate investor for the last kind of since, let's say, 1980, he's constantly rolled into cheaper debt, right? So he's had a constant massive tailwind behind him, right? He may have been like a very good real estate investor, but it was a huge like tailwind behind him. The same as what I think you guys will see in your kind of education is your education will be very like stock specific, right? Because in the last 10 years, stock market's gone up in like a 45-degree line. And I think what Armin's trying to highlight is that, like, if you kind of contextually have a bit of a think about like, okay, well, like, does the next 10 years look like the last 10 years? You'll start to think, okay, well, like, maybe some of this stuff is changing. And the relative kind of stability that we had of kind of global economy, very peaceful kind of thing, is somewhat ending. And that might mean that the areas of finance that you want to be involved in, right, are no longer being in a kind of equities trader at a bank. You know, it may mean that, you know, the guys who are really making money right now are the guys benefiting by moving gas from America to Europe, right? And as these things kind of continue to develop, right, and they grow and they grow and grow, right, you're going to have more and more competition and more bifurcation between all of these different marketplaces, right? And, you know, you want to go and do something you enjoy, but if you can catch a trend as well, what you'll find is that the opportunities available to you within that trend will grow and grow and grow and grow and grow. Okay. And it's a really, really powerful compounding force doing that.
It lifts
May
you
I
up.
ask you may I ask you a follow-up question to that?
Sure.
So, like, you're talking about the trends, you're talking about this, like, a wind that, like, a lot of people got lucky to, and just, I would say, just jumped on the bandwagon, I guess, like, of this trend, I guess. How do you identify this? Like, for example, we currently see like a rise of NFT, bitcoins. We see cryptocurrency. We see rise of metaverse and like virtual reality. How can we be sure that, okay, this trend is not a flop, but it's actual thing? Like in, like, for example, .com boom, right, where we see like a huge rise of like increase of like market capitalization of a lot of websites, but in the end, it turned out to be like a lot of those, 90% of those, I would say, websites just went bankrupt.
Or you can never, you know, like when I talked about decision making, and I think this goes for pretty much everything, there's always uncertainty. Okay, so we can never be, we can never be certain about anything, and I highly recommend you to question anything. It's becoming aware of your decisions that you are making on a daily basis and become better at them. What we are highlighting is that there are interesting trends out there. There's, the crypto, token, NFT market, interesting trends out there. You want exposure to trends, because if they go up a lot, or let's say you have a convex outcome, you put yourself in a position where you have a convex outcome, you will benefit handsomely, whereas others, like they are going up linearly, in a linear fashion. And I think that's like really kind of important to understand, that you do have to predict, even though you might be also like only right like 50% or even less, which is like a totally different topic, because then it's about risk management and then pretty much cutting when you're losing and increasing exposure when you're winning. But like there are a lot of trends out there, okay? like the two that were mentioned today are one of, like, some of those that have massive potential, are not very well understood, and where you can, like, start to position yourself. Let's say you invest a little bit, and what I mean with investment here is, like, invest a little bit of time, understanding for yourself to, like, get some sort of higher conviction if you want to expose yourself, like, further, and then you can, like, start kind of playing around a little bit. So that's a little bit like the rule of the game. And some odds that you might know from the past is historical data that will not come true. So, for example, if you want to be a partner at Goldman Sachs, well, good luck. It's going to be really difficult, because you are, going against the basic odds of how the industry has changed.
Yeah,
right?
I would. I'll give you a real world example if you want one.
Well,
So-
just a little. I just want to make a little summary for myself. So, what you're saying is, like, keep your heads up for all these kind of trends happening, and if you see exposure or growing of this trend, you invest your time into it, your time, maybe some cash into it, to see that maybe it is a potential wave that you can hop into, right?
That's
Yeah,
how you always play everything. So let's say you exercise, you really feel well, you see there's some muscle growing, increase your exposure. Okay. If you see, like, you eat nonsense, okay, and you feel terrible, decrease your exposure. It's a general rule for life in whatever whatever kind of decision you are making.
Yeah, I'll give you a real world example, right? Just so that you can think, and it's quite relevant to finance. So, interesting parts about finance. Okay, most people in banks earn less now than 15 years ago. Okay, regulation, compliance, lack of opportunity has really, like less risk taking has made kind of, like, let's say, front office finance to some degree in secular decline, right? The number of guys doing really, really well is, like, shrinking constantly, right? The pyramid's just getting steeper and steeper and steeper. Armin and I have, like, talked for many years about, like, how we think about the world. Okay, now we've gone off and done this macro mentors thing, and the kind of, like, the Cliff Notes kind of concept was, look, we could see everyone was giving away their time on podcasts, on Twitter. Everyone's giving away their views, right? It's getting much easier to like speak to people. We can also see that it's more people are interested, right? You can see this boom in retail participation in things, and we could also see that there's this kind of digital communications boom going on, right? Now, I sit there in a pretty successful hedge fund, okay, and we are, like, really having to, like, beat down the door of investors, and they're smashing you on terms and all this sort of stuff, right? Now, we are running macro mentors, I would say, like, at the moment, probably not as well as we should. And every single day we have people from around the world sign up, right? We are on a trend where people all around the world are becoming completely empowered and being able to learn. And the demand is just unlimited, right? I've been reading a book on energy, and the stat is there's, like, 3 billion people on the planet who survive on less energy a year than a US fridge. Like, it's like, you have to understand the context, and where Armin's remote theory becomes, like, really, really powerful, right? And we didn't really get to touch on this, is that when we have thought about, like, the rise of China, we have thought about, like, labor moving to China to manufacture things. And we've seen that that's made things much, much cheaper, but it's also caused, like, catastrophic deflation in, like, manufacturing in places like America. And what you're going to start to see is that the sphere of influence for companies for hiring in these service industries, right? The talent pool just got massive, right?
Yes.
Like, once you're prepared to hire someone from a foreign country, like, your pool is enormous, and you see this in, like, the numbers, right? So
the outsourcing industry is exploding right now as we speak. It's hard to invest in public markets, but
So what do you see, right? So, like, I'm a guy who exists, like, let's say I'm an emerging country, right? I'm in West Africa, I'm in Nepal, and I can get access to the internet. I can now like massively upskill versus what was available to me, you know, previously to not having it, right? And now there's solutions like Macro Mentors, Coursera, all these things which are helping educate these people, and the businesses are starting to get prepared to hire them, right? These are like massive secular trends that are like just starting, right? There are billions and billions of people about to enter the global workforce in kind of services.
It's
Okay?
hard to lose if the odds are so much in your favor. And that's what I was trying to explain with the China graph. Like all of my friends that studied with me at Tsinghua got millionaires, became millionaires before they were the age of like 28, 29, very easily, because like the trends was just so much in their favor.
So the idea is not to like, we're not trying to like say like, you have to be a genius to kind of identify these things, right? Obviously, it's like somewhat our jobs. But what you don't want to get into a situation, right, is that you're fighting against them. Okay. Like the game is to try and find something that you're already interested in, right, and potentially quite good at, which is in favor of the trend, right? It's exactly the same kind of thing as I was trying to say with the carry, right? This is like lifestyle carry, right? This is like career carry that you're trying to generate for yourself. And it's a pretty decent piece of advice from Armin. You know, there are certain things that I could have gone into, I think, and I was kind of on the fence of going into technology or finance. And, you know, technology's done nothing but pretty much like double every year for the last decade. And finance has shrunk like materially. And, you know, now I'm 33, you know, with kind of golden handcuffs on, it's a lot harder for me to kind of transition into like a different industry. Now, I can try and become the best within my industry, but I understand that like the opportunities within me are like shrinking somewhat.
And